PhillipCapital Weekly Market Watch. I'm Camelia, business development dealer from Phillip Futures. For this week's episode of Market Watch, I'll be sharing on the performance of the Singapore market and how you can make use of the MSCI Singapore Index Futures, SiMSCI, to ride out the recent market volatility. There are several useful features of SiMSCI, and one of the important features that investors commonly use is hedging. Let me explain how hedging works. Suppose you are currently holding some stock portfolio in the Singapore market and the local stock market is falling. SiMSCI might be the tool for you to protect your stock portfolio. By engaging in short selling of the SiMSCI futures during market downturn, investors have the option of keeping their stock portfolio and at the same time uses the profit made in shorting SiMSCI futures during a market downturn to cover the losses incurred in the stock market. Besides hedging, SiMSCI futures can also be used for speculative trading, where one SiMSCI futures contract allows us to gain broad market exposure to 28 Singapore blue chip stocks like Singapore Telecom, DBS, and OCBC Bank. So far, the performance of SiMSCI has stabilized quite a fair bit after the global rout that took place a few months ago. Prices have rebounded about 10% from the low of 305.86 in September 2015. Although SiMSCI is trading at about 337.3 level last Friday, some fundamentals still remains weak. For example, the Ministry of Trade and Industry has reported that the Singapore economy grew by 1.8% on a year-on-year basis in the second quarter of 2015, which is sharply lower than the 2.8% growth in the previous quarter. On a quarter-on-quarter basis, the economy contracted by 4%, a reversal from a 1.4% growth in the previous quarter. There is also a slowdown in the major sectors like the manufacturing and retail sales sector. The GDP growth forecast for 2015 has also been narrowed to between 2 to 2.5% from the earlier forecast of 2 to 4%. The slowdown in the Chinese market, the world's second largest economy, is another significant factor that will affect the Singapore economy. Based on the chart, the leading indicator for the Chinese economy, Caixin Manufacturing Purchasing Managers Index, strings for the 8th consecutive month at 48.3 in October 2015. A PMI reading of below 50 indicates that the weakening of the manufacturing industry in China. Therefore, this might pose a bearish effect on the SiMSCI prices as China demand strengthens. Lastly, the impending US interest rate hike is another major factor that will affect the whole financial economy in general. The Federal Reserve still remains undecided on when is the interest rate hike and maintain their interest rate decision at 0.25% during the FOMC meeting in October last month, due to concerns about the weak global economic growth. However, in a recent speech by the Fed chairwoman Janet Yellen, she mentioned that the Fed may raise their short-term interest rate in mid-December if the US economy remains on track. This could renew confidence in the market and pave way for an uptrend in the Asian equities. In the short term, I would not expect the upward momentum for SiMSCI to continue as the fundamentals remains weak. Prices should be kept within the resistance of 341.79, which is also the 38.2% of the Fibonacci retracement level. Some profit-taking activity is expected around this level, but is not likely to push SiMSCI lower than the support level of 328.06. However, if the Fed decides to hike interest rate on the next policy meeting on 15 to 16 December 2015, we might potentially see prices break the resistance and go on a bull run to reach the next resistance level of 352.89. With this, we have come to the end of this week's edition of Market Watch. For more information on the risk and return of investing in the SiMSCI futures, you may approach any of the representatives from Phillip Futures. Please subscribe to us on PhillipCapital YouTube channel and Facebook and stay tuned for more Market Watch videos. Thank you.